Here's the thing about market crashes. They don't announce themselves with a marching band. They show up like that relative who borrows money and disappears for 3 years. Quiet. Then suddenly everyone's panicked, and you're standing there wondering what just happened. March 6, 2009. The S&P 500 hits 666 points. That number is not a coincidence, by the way. The market decided to get biblical on us. People were jumping out of windows metaphorically, and in some cases literally. CNBC had funeral music playing in the background of their segments. Okay, not really, but it felt like it. Fast forward to today, early 2026, and I'm seeing the same patterns that made a nurse from Sacramento $4 million, that made a truck driver from Ohio $2.3 million, that made a third-grade teacher named Veronica enough to retire at 52 on a lake house in Michigan. These weren't geniuses. They didn't have inside information. They didn't have some secret algorithm or a rich uncle. What they had was the ability to recognize something that happens roughly once every 10 to 12 years, and the guts to act on it while everyone else was running for the exits. Here's what I'm going to explain today. There's a specific market condition that creates what I call millionaire windows. These windows open when fear drives prices so far below actual value that buying becomes almost mathematically guaranteed to make money, assuming you can wait 3 to 5 years. The last 3 times this happened were 1974, 2002, and 2009. Each time, regular people with regular incomes turned small amounts of money into life-changing wealth. We are going to break down exactly how this works, why it's getting weird right now in early 2026, and the specific signals that tell you when one of these windows is opening. This isn't about guessing. This is about pattern recognition. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Let me tell you a story about a guy named Morris. Morris was a pharmacist in 1973. Boring job, steady income, not particularly flashy. He read the Wall Street Journal at lunch while his coworkers talked about football. In 1973, the market started collapsing. The oil crisis hit. Inflation was spiraling. The S&P 500 dropped 48% over 2 years. People were convinced the American economy was finished, that capitalism itself was being replaced by something new. Morris watched his retirement account get cut in half. His financial advisor told him to sell everything and go to cash. "Preserve what you have left," the advisor said. Morris's coworkers were panic selling. His neighbor lost his business and had to sell his house. But Morris had been reading something most people ignore: historical market data. He noticed that every major market decline in the past 40 years had been followed by a recovery. Not sometimes, every time. The recovery took anywhere from 2 to 6 years, but it always came. So Morris did something that seemed insane. In December 1974, when the market was at its absolute bottom and everyone was terrified, he took $20,000 he'd saved and dumped it into an S&P 500 index fund. His wife thought he'd lost his mind. His advisor literally refused to execute the trade, so Morris found a new advisor. That $20,000? By 1982, it was worth $72,000. By 1990, it was worth $180,000. By the time Morris retired in 2000 at age 62, that initial $20,000 had become $1.2 million. Now you're asking yourself, that's great for Morris, but how does this help me? Fair question. Let me show you the pattern. Think of the stock market like a neighborhood yard sale. Most of the time, the prices are reasonable. Sometimes they're even a bit high because the sellers watched too many episodes of Antiques Roadshow and think their old lamp is worth $300. But every once in a while, something happens. A flood, a fire, a divorce. And suddenly the sellers don't care about getting fair prices anymore. They just want everything gone. Today. They're practically giving things away. That's what happens in a market crash. The sellers aren't rational. They're desperate. They're scared. They're not thinking about what things are actually worth. They're thinking about survival. And if you're the one person at the yard sale with cash in your pocket and a clear head, you walk away with a Picasso for $50. The stock market is just a collection of companies. Real companies that make real products and generate real profits. When Apple stock dropped to $12 in 2009, split adjusted by the way, so don't go looking for that exact number on a chart without adjusting for splits. When Apple dropped that low, did iPhones suddenly stop working? Did people stop buying MacBooks? Did Apple's factories disappear? Of course not. The company was fine. The stock price was broken. There's a difference. This is where it gets really interesting. The disconnect between stock prices and company value creates what I call the gap. The wider the gap, the bigger the opportunity. In normal times, the gap is small. Prices are reasonably close to value. But during crashes, the gap becomes enormous. We're talking 30, 40, sometimes 50% discounts to intrinsic value. Let me give you some numbers that should make you uncomfortable. From March 2009 to March 2010, just 1 year, the S&P 500 gained 68%. From the COVID crash bottom in March 2020 to the end of that same year, 9 months, the market was up over 65%. These are not normal returns. These are generational wealth-building returns, concentrated in very short windows. But here's the problem. Most people miss these windows completely. They're too busy panicking. Or worse, they sell at the bottom and lock in their losses, then sit on the sidelines watching the recovery happen without them. I remember sitting in a meeting at the bank in late 2008. We had a client, successful business owner, worth about $4 million. He'd built his company from nothing over 30 years. Smart guy, tough negotiator. But when the market started crashing, he panicked. He called us every day. He couldn't sleep. He lost 20 pounds. Finally, in February 2009, he told us to sell everything. We tried to talk him out of it. We showed him the historical data. We explained that selling now would lock in losses of 40% or more. He didn't care. He just wanted the pain to stop. We sold everything. By the time he got back into the market in 2011, he'd missed the entire recovery. Instead of his portfolio recovering and growing to $6 or $7 million by 2012, he was sitting at about $2.5 million. That panic cost him roughly $3 million. $3 million. That's not a rounding error. That's generational wealth evaporated because he couldn't control his emotions for 18 months. You might be thinking, that's easy to say in hindsight, but when you're watching your life savings disappear, it doesn't feel like a buying opportunity. It feels like the end of the world. And you're right, that's exactly what it feels like. That's precisely why most people can't do this. The psychology is brutal. Your brain is wired to run from danger. When the market is crashing, every instinct screams at you to get out. The news is apocalyptic. Your friends are panicking. Your gut says sell everything and hide under the bed. But now you might think there has to be more to it than just buy when everyone else is selling. And there is. Let me introduce you to the 3 signals that tell you when a millionaire window is actually opening. Signal number 1. Extreme pessimism in the media. Not just negative news. I'm talking about headlines that use words like collapse, crisis, meltdown, depression. When mainstream publications start running stories about how capitalism is failing, or how this time is different, or how the market will never recover, that's signal number 1. In 2009, Time magazine ran a cover story asking if the recession would ever end. That was the bottom. Signal number 2. Massive outflows from equity funds. When regular investors start pulling billions of dollars out of stock funds and moving to cash, that's a signal. In 2008 and early 2009, investors pulled over $200 billion from equity mutual funds. That was money leaving the market at the exact worst time. When you see this kind of capitulation, when even the buy and hold crowd starts selling, you're getting close to a bottom. Signal number 3. The S&P 500 down at least 30% from its high. Not 10%, not 15%. Those are normal corrections that happen all the time. I'm talking about real crashes. The kind that make the evening news. The kind that make your neighbor tell you he's never investing in stocks again. When you're down 30, 40, 50% from the peak, that's when the math starts working in your favor in a big way. But here's the thing. You can't wait for all three signals to be perfectly aligned before you start paying attention. By the time the signals are obvious, the best opportunities are often gone. The market moves fast when it turns. That 68% gain in 2009 happened in 12 months. If you waited 6 months to make sure the bottom was in, you missed half the move. Now I want to tell you about a woman named Patricia. Patricia was a radiologist in Minneapolis. In 2020, when COVID hit and the market crashed, she was 51 years old. She'd been investing in her 401k for 20 years, just maxing out her contributions, buying the same target date fund every month. Boring. Automatic. She didn't think about it much. But when the market crashed 34% in 23 days, the fastest crash in history, Patricia did something different. She'd been reading about market history. She understood that crashes, especially fast crashes driven by panic rather than fundamental problems, tend to recover quickly. Patricia had $100,000 in cash sitting in a savings account. She'd been saving for a vacation home, but the market crash made her rethink her priorities. Instead of buying a cabin, she decided to make a bet on the recovery. She didn't put all $100,000 in at once. She was smart about it. She divided it into 10 chunks of $10,000 each. She invested $10,000 on March 23, 2020, the exact day the market bottomed. Then she invested another $10,000 every 2 weeks for the next 20 weeks. By September 2020, she'd invested her full $100,000. The market had already recovered most of its losses by then. But because she started buying at the bottom, her average purchase price was incredibly low. By December 2020, her $100,000 was worth $145,000. By the end of 2021, it was worth over $200,000. Patricia turned a 6-month window of opportunity into $100,000 of gains. She didn't try to pick individual stocks. She didn't use options or leverage or any complicated strategies. She just bought broad index funds when everyone else was terrified. Now, you might be thinking, okay, but what about risk? What if the market doesn't recover? What if this time really is different? These are fair questions. Let me address them directly. Yes, there is risk. The market could stay down longer than you expect. Individual companies can and do go bankrupt. The economy could take a decade to recover instead of 2 or 3 years. These things have happened in other countries. Japan's stock market peaked in 1989 and didn't recover for over 30 years. But here's what you need to understand about the US market specifically. The United States has the most resilient economy in modern history. We've survived a civil war, 2 world wars, the Great Depression, 17 recessions, a presidential assassination, multiple financial crises, a terrorist attack on our financial center, and a global pandemic. Every single time, the economy recovered. Every single time, the market eventually made new highs. I'm not saying this to be patriotic. I'm saying it because the data backs it up. From 1950 to today, there have been 11 bear markets, defined as declines of 20% or more. The average decline was 33%. The average recovery time was about 22 months. Every single bear market was followed by a bull market that more than made up for the losses. To be fair, past performance doesn't guarantee future results. You've heard that disclaimer 1,000 times. But there's a difference between doesn't guarantee and doesn't inform. The past doesn't guarantee the future, but it sure as hell gives us a pretty good idea of the probabilities. This is where I need to tell you something uncomfortable. Most of you watching this video will not act on this information, even though the logic is sound, even though the history is clear, even though the opportunity is real. Most of you will do nothing. You'll tell yourself you're waiting for more clarity. You'll tell yourself you need to do more research. You'll tell yourself the market might go lower, so why not wait? And then one day you'll wake up and the window will have closed. The opportunity will be gone. And you'll be exactly where you are now, except 5 years older, with the same amount of money, wondering what happened. I saw this pattern over and over during my 20+ years in banking. People would call me asking about opportunities, and I'd explain the math. I'd show them the data. I'd lay out the probabilities, and then they'd thank me for my time and do absolutely nothing. 6 months later, they'd call back, angry that they'd missed the move, asking if it was too late to get in. Usually, by the time they were ready to act, the easy money had already been made. The window we're in right now, early 2026, is interesting. We're not at the kind of bottom we saw in 2009 or March 2020, but we're also not at the frothy peaks we saw in late 2021 when everything was expensive and the forward returns were terrible. As I record this, the S&P 500 is up about 75% from the October 2022 lows. That's a significant recovery. But we've also seen increased volatility. Certain sectors, particularly technology and growth stocks, have experienced meaningful corrections. Interest rates remain elevated compared to the zero interest rate environment we had from 2008 through 2022. Inflation has cooled but hasn't disappeared. Consumer confidence is shaky. The key question is whether we're in the middle of a prolonged period of sideways movement, what's sometimes called a lost decade, or whether we're setting up for another major buying opportunity. Here's what the data suggests. Since 1950, the average price-to-earnings ratio of the S&P 500 has been about 16. When the market trades significantly above that level, like it did in the late 90s at over 30 times earnings, future returns tend to be poor. When it trades significantly below that level, like it did in the early 80s at around 7 times earnings, future returns tend to be spectacular. Right now, we are somewhere in the middle. Not cheap, but not astronomically expensive either. That suggests forward returns will probably be moderate. 10, maybe 12% annualized over the next decade. Nothing to write home about, but not terrible. But, and this is important, averages hide the actual experience. The market rarely delivers average returns in any given year. It delivers extreme results. Up 20% one year, down 15% the next, up 8% the year after that. The average might be 5%, but you'll never actually see a 5% year. What this means for you is that even in a mediocre overall environment, there will be moments of extreme pessimism. Moments when fear drives prices way below value. Those are the millionaire windows. They don't require the entire market to be cheap. They just require enough fear to create a dislocation. Let me tell you about the neighborhood pond. There's this pond in my town where people fish. Most days you'll catch nothing. The fish aren't biting, but every once in a while, usually right before a storm when the barometric pressure drops, the fish go crazy. They'll bite on anything. A bear hook, a piece of bread, doesn't matter. They just attack. The old-timers know this. They watch the weather. When a storm is coming, they grab their gear and head to the pond. Everyone else is running for cover, but the old-timers are pulling out fish after fish after fish. Market crashes are like that. The barometric pressure drops. Some crisis hits. Some panic sets in. And suddenly, there are opportunities everywhere. Good companies selling at half their value. Blue-chip stocks with dividend yields that haven't been seen in decades. Index funds trading at 30% discounts to their recent highs. But you need to be ready. You need to have your gear packed. You need to have cash on the sidelines, waiting to be deployed. If you're fully invested with no cash when the crash hits, you can't take advantage. You're a spectator, not a participant. This is something most financial advisors get wrong. They'll tell you to be fully invested at all times. They'll say things like, time in the market beats timing the market. And there's truth to that. If you're investing regularly over a long period, you'll do fine. But if you want to do better than fine, if you want to hit the ball out of the park, you need to have some dry powder ready for when the opportunities appear. I recommend keeping 5 to 10% of your portfolio in cash or cash equivalents at all times. Not under your mattress, but in a high-yield savings account or money market fund. This cash serves two purposes. First, it gives you a psychological buffer. When the market crashes, you can look at that cash and know you have options. You're not trapped. Second, it gives you ammunition. When the millionaire window opens, you have capital ready to deploy. But you might be thinking, 5 to 10% in cash? That's a drag on returns. Cash earns almost nothing compared to stocks. True, cash does earn less than stocks over the long run. But that's the price of optionality. You're paying a small insurance premium for the ability to act when everyone else can't. Think of it this way. If you have $50,000 in cash earning 4% while stocks are earning 8%, you're giving up $2,000 a year in opportunity cost. But if that cash allows you to buy $50,000 worth of stocks at a 30% discount during a crash, you've made $15,000 instantly. That's 7 years of opportunity cost recovered in a single trade. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now, let me give you a concrete example of how this works in practice. Let's say you're 42 years old. You have $300,000 in your retirement accounts. You're contributing $2,000 a month to your 401k. You have $20,000 in cash sitting in a high-yield savings account. The market starts crashing. Maybe it's a recession. Maybe it's a geopolitical crisis. Maybe it's something nobody predicted. Over 6 months, the S&P 500 drops 40%. Your $300,000 is now worth $180,000. You've lost $120,000 on paper. This is where most people make a crucial mistake. They look at that $120,000 loss and they panic. They sell, they go to cash, they lock in their losses. But you're not most people. You've watched this video. You understand what's happening. Instead of selling, you start buying. You take that $20,000 in cash and you deploy it into the market. You don't do it all at once. You do it over 4 or 5 months, buying chunks every few weeks. Fast forward 3 years. The market has recovered. Your original $300,000 is back to $300,000. But that $20,000 you invested at the bottom, it's now worth about $35,000. You made $15,000 in profit from the crash. The crash that destroyed other people's wealth actually increased yours. Now let's zoom out. What if you had kept more cash on the sidelines? What if you'd had $50,000 ready to deploy? That $50,000 could have turned into $87,000. What if you'd been aggressive and moved some of your bond allocation into stocks during the crash? The numbers get even bigger. This is how regular people become millionaires. Not by picking the perfect stock, not by timing the exact bottom, but by recognizing when fear has created a disconnect between price and value, and having the courage and the capital to act on it. Here's a quick comedic aside. My former boss at the bank used to tell clients, the best time to invest was 20 years ago. The second best time is today. Then he would charge them a 2% management fee and put them in funds that underperformed the S&P 500. He's retired now, lives on a boat. Your fees paid for that boat. You're welcome, I guess. Anyway, back to the main point. The last time we had a true millionaire window was March 2020. That was 6 years ago. Before that, it was March 2009. That was 11 years earlier. Before that, October 2002. That was 7 years earlier. Do you see the pattern? These windows don't appear on a perfect schedule, but they appear roughly once every 7 to 11 years. That means we're due. Not guaranteed, but due. The conditions are building. Volatility is increasing. Sectors are cracking. The smart money is raising cash. When the window opens, it won't stay open long. The biggest gains happen in the first 6 to 12 months of a recovery. If you're not prepared, we'll miss it. And then you'll spend the next decade reading articles about the people who got rich during the crash of 2020-something, wondering why that couldn't have been you. So here are 3 practical takeaways. Not generic advice, specific actions. First, build your war chest now. If you don't have cash on the sidelines, start building it. Sell some of your winners. Reduce your equity allocation by 5 or 10%. Put that money in a high-yield savings account and don't touch it until the crash comes. This cash is your ticket to the millionaire window. Second, make a written plan. I mean, literally write it down. When the S&P 500 drops 30% from its high, I will invest 50% of my cash into the market over the following 6 months. Or whatever your specific plan is. The point is to decide now, while you're calm and rational, what you'll do when things get crazy. Because when things get crazy, you won't be calm and rational, you'll be scared. Your written plan is your anchor. Third, educate yourself on market history. Read books like Stocks for the Long Run by Jeremy Siegel. Read The Psychology of Money by Morgan Housel. Read A Random Walk Down Wall Street by Burton Malkiel. Understand what has happened in the past so you can recognize it when it happens again. The patterns repeat, the names change. .com bubble, subprime crisis, COVID crash, whatever comes next. But the psychology is always the same. Lazy investing built more fortune than crypto memes. That's not a slogan, that's a fact. The people who bought boring index funds at the bottom of crashes and held for 10 years outperformed every crypto bro, every day trader, every hotshot hedge fund manager you've ever heard of. They didn't work harder, they didn't have better information. They just understood the game and had the patience to play it properly. Let me end with this. There's an old saying in finance. The market can remain irrational longer than you can remain solvent. That's true if you're using leverage. If you're borrowing money to invest, a crash can wipe you out before the recovery comes. That's why I never recommend using debt to invest in stocks. Ever. But if you're investing your own money, if you have time on your side, then that saying is wrong. The market cannot remain irrational longer than you can remain patient. You can wait. You can hold. You can sit through the crash, the recovery, and the new highs. You have that power. The last 3 times this happened, regular people became millionaires. The teacher, the truck driver, the nurse. They weren't special. They were just prepared. They recognized the pattern. They had cash ready. And they had the guts to act when everyone else was paralyzed by fear. The next millionaire window is coming. Maybe this year, maybe next year, maybe 3 years from now, but it's coming. The only question is whether you'll be ready for it. History doesn't repeat, but it rhymes. The crash will come. The panic will be real. The headlines will be apocalyptic. And if you've done your homework, if you've built your war chest, if you have a written plan, you'll recognize it for what it is. Not a crisis. An opportunity. The opportunity of a lifetime. Don't waste it.